You know that feeling when the market goes into a total freefall? We all start scrambling for what we think are the financial life rafts, but what if some of those so-called safe assets are actually the anchors pulling the whole ship down? Well, a brand new study just put our biggest assumptions to the test, and trust me, the results are going to surprise you. So, that's really the big question we're digging into today. In the whole messy drama of a market crash, which assets are secretly spreading the panic, and which ones are quietly absorbing the shock? We've got a few key suspects lined up. First up, we've got the rebel of the group, Bitcoin. You know the reputation. It's volatile, it's high risk, it's totally unpredictable. The common wisdom says it's just a speculative gamble, an asset that just adds fuel to the fire when things get chaotic. Then we have our supposed hero, green bonds. I mean, these are designed to be stable, funding awesome environmentally friendly projects. They're meant to be the responsible choice, right? The safe harbor in a storm? Next, we have renewable energy stocks. These kind of represent our collective bet on a cleaner future. And while a lot of investors see them as this huge growth opportunity, what they actually do during a financial crisis, well, that's been a big question mark. And finally, there's the old guardian gold. For centuries, this has been the ultimate safe haven asset. It's the bedrock investors run to when everything else is falling apart. Its reputation is, well, golden. But does it still hold up today? To figure out who's the hero and who's the villain, researchers used this really fascinating new method to see how these assets actually behave when they're under pressure. Think of it like a financial stress test for the entire system. The key idea they measured is something called financial connectedness. Now, it sounds a little academic, but the concept is super simple. It's basically a way to see how panic in one asset, let's say Bitcoin, spills over and infects everything else. The higher that connectedness, the faster a crisis can spiral out of control. So, how did they actually test this? They used what's called a quantile approach. Instead of just looking at average, boring days, they split the market into 3 different states. You've got your calm days, then the absolute worst crash days, and then the most extreme boom or mania days. This is brilliant because it lets us see if an asset completely changes its personality when the heat is on. So let's get to the good part, the evidence. Let's see what this stress test actually dug up. When exactly does this connectedness spike, and when does the risk of contagion get really, really high? The study looked at a period that was just packed with turmoil. I mean, perfect timing. It covered the US-China trade war, the global shutdown from the COVID-19 pandemic, and, of course, the US banking crisis in 2023 with the collapse of Silicon Valley Bank. These were the real-world stress tests. And this is where you can actually see the panic. This heat map here shows the total financial connectedness of all these assets over time. The brighter and hotter the color, the more panic is spreading through the system. And look at those intense yellow hot zones. They line up perfectly with the crises we just talked about, the trade war, the pandemic, the banking stress. During those moments, the whole system became dangerously intertwined, with risk just spilling over everywhere. Okay, so we know the system gets really fragile during a crisis. But now it's time for the big reveal. Which of our assets were spreading the risk, and which ones were actually soaking it up? The study puts assets into one of 2 roles. A shock transmitter is kind of like a loudspeaker. It takes a financial shock and just blasts it out, making the panic worse for everyone. On the other hand, a shock receiver is like a sponge. It actually absorbs shocks from the rest of the system, helping to calm things down. So let's start with our hero, right? Green bonds. They're designed to be stable, to be safe, so during a crisis, they should be a shock receiver, a safe harbor, right?
Well, here's the first major plot twist. This chart shows the behavior of green bonds. Red means it's a transmitter, spreading shocks, and blue means it's a receiver, absorbing them. And as you can see, that deep, deep red tells a pretty shocking story. During every single major market crisis, green bonds were consistently a net transmitter of shocks. So instead of being a safe harbor, they were actually making the panic worse.
Okay, so if the hero is actually a villain, what about the rebel? I mean, surely Bitcoin, with all its crazy volatility, is just pouring gasoline on the fire. It has to be the ultimate shock transmitter, doesn't it? Okay, prepare yourself for an even bigger surprise. Remember, blue means an asset is absorbing shocks. Now look at the data for Bitcoin. It's overwhelmingly blue. This means that during those exact same crises, Bitcoin was consistently acting as a net receiver of shocks. It was the sponge, not the loudspeaker. So despite its own wild price swings, it was actually absorbing risk from the rest of the financial system. Wild. So what about our other two players, renewable energy and gold? Well, their stories are a little bit more complicated. It turns out their roles aren't fixed at all. They're kind of shifty. Let's look at their heat maps side by side. You can see these patches of red where they're transmitting shocks, and then patches of blue where they're receiving them for both assets. This shows they kind of have a dual personality. Renewable energy stocks, for example, were spreading shocks during the pandemic, but absorbing them at other times. And gold did the same thing. It switched roles, acting as a shock absorber during COVID, but a transmitter during other periods.
Okay, wow. Some major assumptions have just been turned on their head. So what does all this mean for us? For building a portfolio that can actually weather a storm? What are the new rules of the game?
Think of this as your new cheat sheet. Green bonds, surprisingly, spread risk in a crisis. They are not the safe harbor we thought. Bitcoin, against all odds, tends to absorb systemic risk. And both renewable energy and gold are, well, they're complicated. Their role depends entirely on the specific nature of the crisis. It just goes to show that in today's financial world, the old labels of safe and risky just don't cut it anymore. Context is everything. This research gives us a powerful new snapshot of how markets really work under pressure. It forces us to look past the headlines and understand these deeper connections. But it also leaves us with one critical question. As these assets grow up and the markets keep changing, will these roles stay the same? That is the billion-dollar question for whatever crisis comes next.